The Indian rupee has been on a downward spiral for the last few days, and on Wednesday it hit a record low of 79.03 against the US dollar. This has sparked a debate among analysts about whether the domestic currency could see further decline amid weak fundamentals. Since January of this year, the rupee has fallen approximately 6%. However, on Thursday, it managed to recover from its record low after gaining 13 pace to hit 78.9 against the dollar. With the economy struggling from rising inflation and the prices of ordinary commodities skyrocketing, this is a double blow for the average man. However, Union Finance Minister Nirmala Sitharaman recently stated that the Indian rupee is substantially better positioned than other foreign currencies versus the US dollar. Meanwhile, while currency volatility persists, let us clarify what this represents to you. But before we go on, make sure to subscribe to our channel so you receive more of our interesting videos. Both supply and demand influence the strength of the Indian rupee in respect to the US dollar. When the US dollar is in strong demand, the Indian rupee falls in value, and conversely. If a country buys more than it exports, the demand for the dollar exceeds the supply, and the native currency, such as the Indian rupee, depreciates versus the dollar. The rupee's current decline is mostly owing to rising crude oil prices, a strong dollar abroad, and international capital outflows. The rupee has been falling since early this year, owing to supply chain delays caused by the Russia-Ukraine conflict, worldwide economic problems, inflation, and rising crude oil costs, among other factors. Furthermore, there have been significant foreign capital outflows from domestic markets, with foreign institutional investors selling shares worth $28.4 billion so far this year, outpacing the $11.8 billion sell-off recorded during the 2008 global financial crisis. Thus far this year, the rupee has fallen 5.9% against the US dollar. Nevertheless, the US Federal Reserve has raised interest rates, increasing the yield on dollar assets relative to those in emerging nations such as India. The US Fed is expected to raise interest rates more aggressively, which might further weaken the Indian rupee. India relies largely on crude oil imports to cover more than 80% of its energy needs. Once oil prices climb, the rupee suffers as India's import expenses rise in response to increased crude prices. Brent crude reached $110 per barrel in May and has since risen to $122 per barrel. If oil prices continue to rise, imports will follow suit. This increases demand for the US dollar, which improves it versus the rupee. The Indian rupee has been losing value from January of the current year, thereby reducing its purchasing power in the foreign markets. Because India relies heavily on imports such as crude oil, commodities and electronics, the country pays payments in US dollars. If the rupee falls in value, it will have to spend more to purchase a similar number of goods. In such circumstances, the cost of raw materials and manufacturing rises, and this is transferred to the customers. A falling home currency, while on the other side, stimulates exports by making goods extra attractive and giving international customers greater purchasing power. Yet, given the current environment of poor international demand and ongoing volatility, exporters are opposed to currency depreciation. The weakening rupee has the greatest influence on inflation, since India imports more than 80% of its crude oil, which is the country's largest import. After Russia's invasion of Ukraine, global petroleum prices have been over $100 per barrel. Soaring oil costs and a falling rupee would further exacerbate the economy's inflationary pressures. Because India is a net importer of goods and services, every depreciation in the Indian rupee may wreak havoc on the country's trade imbalance and place additional strain on its financial well-being. According to figures released for July 2022, India's trade deficit increased to $30 billion, despite a 2.14% increase in exports over the same time in the previous year. Payments for oil and petroleum products account for a sizable portion of the country's import cost and have been rising since the commencement of the Russia-Ukraine crisis. Furthermore, while exports of electronic goods, rice, refined petroleum and chemical products have grown significantly since the last 2 years, declining worldwide demand has impacted exports of cotton yarn, medicines, engineering items and gems and jewellery. In the event that import costs pressures persist to grow, India's trade balance might deteriorate significantly, causing the rupee to collapse further. The obvious effect of a weaker rupee is higher borrowing rates for enterprises that have borrowed funds from overseas markets via loans or bonds. Whereas the situation for raising finance from developed markets was fairly compelling in the aftermath of the COVID-19 pandemic, increased interest rates in markets such as the United States, United Kingdom, and other large economies, combined with a weakening Indian rupee, can be disastrous for over-leveraged Indian businesses. Investors would be wise to avoid new purchases in such firms' stocks and to keep current positions low. Companies with a strong balance sheet and considerable cash reserves should be chosen, especially if values have become more appealing amid the present consolidation in the Indian equities markets. Some analysts anticipate the rupee will proceed to fall against the dollar in the coming days as oil price rises persists. Analysts believe that the foundations of the Indian economy have weakened. Yet, here is where the Reserve Bank of India steps in and takes steps to halt the runaway collapse. In May, it leveraged India's massive currency reserves to keep the rupee from falling below 77.5 versus the US dollar. There is a likelihood that the central bank would intervene again if the currency falls further. Recently, Reserve Bank of India Deputy Governor Michael D. Patra stated that the central bank will not tolerate jerky movements in the rupee and emphasized that the Indian currency had seen the least depreciation in recent decades. We will stand for its stability and we are doing it. We are there in the market and we will not allow disorderly movement of the rupee. We have no level in mind, but we will not allow jerky movement. That is for certain, Patra had mentioned. With the Reserve Bank of India ramping up measures to prevent further depreciation of the Indian rupee, a recovery is possible if foreign money inflows reverse their trend and stimulate development of the country's courses. Despite significant headwinds threatening to derail the post-COVID global recovery and its possible negative ramifications for the Indian economy, several listed companies are profiting from the Indian government's recent supply-side reforms. Long-term investors may want to explore these chances and make prudent purchases in attractive equities during this period of consolidation. Did you find this video interesting? If so, don't forget to hit the like button, subscribe to the channel and share your thoughts in the comments.